If that wasn't a better depiction of our situation, then I don't know what is. Talk of zero or negative interest rates has become more and more commonplace in North America, and the market has even begun to price in this possibility. If you've been watching the news, you may have heard them talk about this, but hold on here. What does negative interest rates actually mean? Would you really get paid money to take out a loan? That would be pretty neat. But don't forget that this would actually go both ways, which means that you could be charged money to keep your savings at a bank, and that would be not so neat. Negative interest rates are a little bit whack, so why don't we go ahead and take a step back to get our minds understanding back on track and give that like button a great big smack. Sorry, what I tried to say there before the urge to freestyle came over me was that in order to understand our current debt predicament and to understand the possibility of negative interest rates, we'll have to understand how debt cycles work in the economy. What is a debt cycle, you might be wondering? Well, it's how debt levels in the economy, which means debt from me, you, and Mr. Magoo, and the government too, cycles up and down across decades and even centuries. And the reason debt cycles up and down in this way is because humans do repeatable and predictable things over time. Let me explain. After watching this video, you'll be able to drop some serious knowl to the edge at campus bars just like Will Hunting. Oh, and you'll probably be a little bit more conscious about any debt that you might have, hopefully. There's three main factors to understand when talking about a simplified version of a debt cycle: income growth, debt growth, and the central bank interest rate. Let's talk about income growth and debt growth first. In an ideal scenario, income growth would be able to grow faster than debt levels, or at least in line with it. But what we're actually seeing is debt levels grow much faster than income is. When debt expands this way, it can make the economy appear that it is doing well, and that's because people use this debt to purchase goods, services, and financial assets like stocks. And this can actually inflate assets like housing, for example, which is what we've seen over the past little while. But debt can't keep rising faster than income forever. It can cause some major problems like inflating those assets like I just talked about. If you look at many major metro cities in North America, for example, you'll see that housing prices are almost out of control at this point. And if debt levels outpace income growth for too long, then we generally see an economic slowdown affect the economy. And in our case, we have the pandemic. This is where we introduce the third factor that comes into play, the central bank interest rate. Under normal circumstances, the central bank would be able to lower its interest rate, which would then provide stimulation to the economy to try and help it. How do they stimulate the economy? Well, the first thing they do is make it easier for you to service your debt. For example, if you had a loan of $10,000 and owed 10% interest on that loan, that means you would owe $100 in interest. But if your interest rate was lowered to 1%, you would now only owe $10 in interest, making it much easier for you to afford that loan. So the central bank can lower their interest rate, which then cascades the effect into the banking system and then trickles down to you as the consumer and can benefit you in this way. Also, this is a really big one. Central bank action like this, lowering the interest rate, can actually make items bought on credit cheaper. Yes, that's right. So by lowering that interest rate, you effectively make things like homes or cars cheaper. How? Let's say you're looking at buying a home for $100,000. And just to keep things super simple, let's say you just took out a 25-year mortgage at a 5% interest rate, and let's forget about the down payment and all the extra fees and stuff associated with it. This means that the total cost of the home over 25 years will be $175,000 because $75,000 of that is interest that you'll have to pay on the mortgage. But what if we lowered the interest rate to 2%? Now the total cost of the home is only $127,000. That's about $50,000 cheaper just by knocking off a few percent on the interest rate. See how powerful changes in the interest rate can be? So that's how assets bought with credit become cheaper when you lower the interest rate. And so this stimulates the economy because people can afford bigger and better homes and other things. But since more people can afford better homes, this actually causes the demand for housing to increase, which then causes the price of homes to increase alongside of it. Aha, now we see how those assets can inflate because of this effect on the economy. Asset prices, like homes, have inflated alongside debt levels. At the turn of the century, the federal fund rate in America hovered around 6%. The federal fund rate is just the central bank's interest rate. After the dot-com bubble and the Great Recession, the Federal Reserve lowered the interest rate temporarily to stimulate the economy. But after they do this, they try and raise the interest rate back up sooner rather than later because debt begins to grow when the interest rate is lower and inflate asset values like I just discussed. But here's the problem. Look at the end of this chart. After the Great Recession, the Federal Reserve was only able to raise interest rates to just over 2%. They were nowhere near that 6% they started at. And then the pandemic hit. The reason why this is a big problem is because when you start somewhere like having 6% interest rates and then you go to drop them down below 1%, that gives you so much room to work with to try and stimulate the economy by lowering that interest rate over 5 percentage points. But when you're only starting at a level just above 2%, you don't have that much room to drop them. I mean, you're very close to the 0% floor at this point. You could theoretically drop them below zero and have negative interest rates like some countries in Europe have or Japan has had, but it's still not clear. We still don't really understand if this further stimulates the economy or any other effects that this can create. So what happens now? What happens when debt levels are really high in the economy and the interest rate is already very low? Well, if we look back in history, generally what needs to happen is something called a deleveraging. And a deleveraging can be a bit of a painful process because it means that debt levels have to decrease below income levels. But this is painful because when you deleverage, you lower spending in the economy, which also lowers income. As a rule of thumb, you can kind of think of one person's debt as another person's asset. So by lowering debt, you also lower the matching asset. And this then trickles down the economy by slowing the purchase of goods, services, and financial assets. And then this goes on to essentially build a negative downward spiral in the economy where one person's lowered spending becomes another person's lowered income, and so on and so forth. Think about it this way. I can go to a store and buy something with either cash or credit. Both function exactly the same as money. So if there's a lot of credit in the economy, you can have a strong economy because there will be a lot more demand. I can just go around and swipe. But don't forget, that money is owed to someone. And so eventually when I have to pay that back, I'll have to come up with more cash than I originally spent in credit. And this means more money needs to be in the system so I can service my debt. But because interest rates are at the 0% floor, the central bank can't really pump money into the system in the way they need to. So ultimately what we're left with is a few things. A fall in spending means a fall in incomes, and a fall in incomes means a fall in asset prices because people have to sell those assets for cash. And also because people have lower incomes, they're more likely to default on their loans, which means that you're also putting stress on the financial system. So banks are going to take a hit because of those defaults. And now you've got a big problem on your hands. Then what does this mean for us? How do we get ourselves through this situation? Well, from my own research on the subject, it looks like there's kind of 3 factors at play that can help us get through this. The first is what is known as austerity. And austerity basically just means spending less money and saving more. This allows us to be able to save more money. It allows us to be able to pay down our debts easier. But this action usually has a negative or deflationary effect on the economy because people are spending less money. And people need to spend money to keep the economy going. But this austerity allows us to deleverage by paying off our debts. The second process is a restructuring of debt. And a restructuring of debt basically means that the terms of debt obligations will be renegotiated. So let's say that I loaned you money, but you weren't able to pay me back that money because you were struggling. So then you would come to me and say, hey, I can't pay you back all this money right now, so maybe you'll let me pay you less money now, or maybe we could stretch the loan out a little bit longer so I have more time to come up with the money. This is a restructuring of the original deal that we had in the first place. This helps you because it makes it easier for you to service your debt, but it ultimately negatively impacts the economy because I'm most likely a bank that's loaning you the money. So banks are going to take a hit in this way when debt gets restructured because they're going to probably get paid less money back than they had originally loaned out. And the third process is the central bank printing money. So now this process here is actually the one that balances out the other two that we just talked about, austerity and the restructuring of debt. Remember that I said that austerity and restructuring debt has a negative or deflationary effect on the economy, which means that it slows it down. But the central bank printing money effectively pumps more available money into the system, which stimulates the economy and has an inflationary effect on the economy. So this is basically done to try and counteract those two negative forces. And these three actions done in harmony can maybe help North America move through this debt problem that we're facing. But it's easier said than done. And a big part of that is because it generally goes against human nature. And human nature is the reason that we experience these debt cycles over time. And that's because we feel emotions. So when times are good, we can feel irrationally exuberant. And when times are bad, we can feel hopelessly pessimistic. So that's what causes a cycle instead of just a nice straight line progression. Personally, I think that a lack of financial education is also a big contributor to this problem. This is exactly the problem I'm trying to solve with this channel, Cash College, because it's my mission to bring accessible financial education to everyone. And if this is your first time here, then please go ahead and subscribe. I think you'll learn a lot of really great information here that can really help you out. And ultimately, if we can all learn this stuff and work together as a team, then I think that's how we're going to be able to solve these really big problems. And so I hope that helped you understand a little bit more if you're watching the news or something and you hear some talk about 0% or negative interest rates or debt bubbles and debt cycles or anything else like that. And so with that all being said, I'm Steve Antonioni and this has been Cash College on negative interest rates and debt cycles. Thank you all so much for watching and I will see you again soon.